told you how you can finance your businesses using soft loan from both private individuals and corporations, as well as grants. So today we are going to look at another dimension of financing your real estate business. What are other sources that you can use to finance your business? That's a very interesting topic we are discussing today. Usually we start by telling a short story, and today we have Egbe Osaje in today's story. Egbe Osaje is a newcomer in the real estate sector. He has excelled in other businesses, but he has decided to venture into the real estate. He has some money that he wants to start up his business with. He doesn't want to take loans to take up the new venture that he has decided to go into. But then he's searching for alternatives to raising funds for his business. So someone told him about getting a business registered and giving out a part of it to these persons that are going to give him some money. So he wants to understand better, what is this really about? Giving out a part of my business, using my own business that I'm setting up to raise money to also finance that same business. That's what we'll be discussing today. He wants to get more details on how this new idea that someone is sharing with him works. Doesn't mean that A is going out and B is coming in. What this is all about. That's our own discussion today. So our topic for today is an insight into equity financing in real estate sector. An insight into equity financing in real estate sector. When we talk about equity financing, what does this mean? Equity financing simply involves a party who owns a business or a business owner giving out a part of his business to persons who in turn invest in his business. That is, you are giving out a certain amount of shares. Now, this does not include the business name. The business name, it will be difficult for you to do that. But for a company gives out a certain unit of its shares to private individuals or corporate individuals to come and invest in the company, and that investment, the persons get profits at the end of the day. This person is getting profits, unlike the other side where you get interest and all of that, but here you get profits. So a person who operates on this equity financing, what he does is to give out a certain amount of the shares he owns as a company. Then these persons also bring in money. So you are using your shares as security for the investment these persons are making. So instead of getting loans, you are selling what you already have to get money to fund your project. Now, why do people request money for their businesses? It could be to start, to expand, or even to complete a particular project. Now, we understand that certain persons, once they give you a project, they give you a certain amount, then they tell you to complete the project before you can get the balance, because they want to know that you are actually committed, to avoid situations whereby persons, once they receive the money that they have requested to complete a particular project, they run away with that money. But once they see that you are the one to do the job with your money and you don't have that money readily available to you, you need to seek funding from somewhere else, either by taking loan or by giving out shares in your company. Now, when we now talk about equity financing, it involves you selling a part. Let's put it that way. You are selling a part of your assets. The assets here is the shares of your company. You sell, let's say you have about 1 million shares in your company and you are a startup company. You need to raise funds, or you need to get persons to invest in your company. You started the company alone because by virtue of the new Karma 2020, a person can set up a company all alone, compared to the position before where you need to have at least 2 persons. But now you can have an individual setting up a company all by himself. Now, Mr. A sets up his own company, 1 million share capital, he decides to give out 200,000 shares out of the 1 million to investors. These investors, they are bringing in certain amount of money. Now they want to be a part of the company. This is where equity financing comes in. These persons, they want to be part of the company. They want to have certain shares. They want to have certain control over the affairs of the company. They bring in money, and the person who is the owner of the company gives out a certain amount of shares to this person, and that gives some sense of ownership to this person. There are some persons, once they know that you don't have any security in your company, they are reluctant to invest. But once they now see that they have certain level of control, they have a say in your company, they tend to invest more. So this is one way you get finance to your business. You tell the person, okay, I'm going to give you a percentage of my company. You are going to exert some level of control. You are going to sit on the board of directors. You are going to be a part of the decision-making body of the company when you invest with us. Now, once this person knows that he has a stake, at that in that company that you are sharing the idea with him, he is likely to invest. So the investment this person is bringing in, you use it to finance the project you have at hand. You use it to expand your business and some other things that you also want to do. There may be some new markets you want to penetrate into, but you don't have the resources to penetrate those markets, or it's a stronghold for another business, and you are coming in to give competition to an existing business. Once you are able to pitch this idea to these investors, okay, I'm going to give you a certain number of shares, you give me the funding to get into this market, and once that is done, the deal is sealed. You get the funding that you need, and the person gets access to your company. Now, there are different types of equity investors. So we are going to be discussing some of these persons or these categories of persons. Now, the first one we have is angel investors. So persons may be wondering, angel, what do you mean by angel investors? Are they going to come from heaven or from some place somewhere? No, these are human beings that are living here with you. When we mean angel investors, these are persons who are wealthy individuals in the society. They are looking for businesses, especially startups. You see, this person has potential of growing in the near future or in the long term, and they want to tie their money down somewhere where they know, okay, this money is secured and they are going to be getting returns from time to time. So these persons, they are not going to take over your company per se, as other persons may want to do, but these persons just want to invest in an idea that they are saying, okay, if this idea is properly nurtured and is allowed to grow, it's going to be something big in the future. So these persons, they put in the money there, they help. They also don't only give you the finances, they also share ideas. Like I stated earlier, you want to break into new markets. These persons, angel investors, they link you up with some of their friends. They have friends, associates that they have been doing business with for a long time. You, as a company owner who has the idea, they link you up with these persons and they tell you, okay, this person can even bring in more money than I already have. These are the persons you can sell these products to. These are the persons that can buy some units in the estate you want to build in so place. This is one of the things that angel investors do for you. They help you penetrate markets, they give you connections, they also give you the finances you need to function in that new space that you are getting into. They also give you that experience. There are persons who are experienced in real estate sector, but they do not have the idea or the skill to manage a company per se, but they know persons who are in the industry and they also have the finances. So these persons, once they see someone who has that idea that they need, they don't just have that idea on how to go about it. Once they see that you are someone that has that idea, they invest in that business because they know how to go about some other things. Just that particular idea on how it functions, that's what they don't have. So these persons, they help you to build your business in expectation that they will get returns at the end of the day. Another category we have is initial public offer. Now, what this means, they usually call them IPO, initial public offering. Now, when you are a company, it's usually for public companies, that's big companies, not just startups. Only few startups get to enjoy this privilege. Now, if you want to raise funds for your company, you need to be listed in the stock market. You need to meet some requirements with the Security and Exchange Commission. Now, once your company is listed in the public space, investors come in, they purchase your shares. Once they purchase, they bring in their money into your company, and you use that money to finance the project you want to finance, to also get into new markets you want to get into, as well as expanding your company. Some persons just need money to expand because they believe once they expand their businesses, they are going to make more profit. Now, these persons, they only invest when they see that there is great potential in this company. They don't just go into stock markets and start buying. They need to see the history on how you have been doing, your credit score and all of that. How have you been faring in the past 1 year, in the past 2 years? Has your stock been rising, or it has been? What's the value of your shares? So, as a person who wants to go into this, to use this route to get investment, you must ensure that your shares are doing very well in the public space. That's one way you can survive with this. And also, if you have the intention of raising money through this means, you must ensure that you meet up with the requirements that SEC may give you, Security and Exchange Commission. There are certain requirements that you put out there, both financial and other legal requirements. You must meet them to be a public quoted company. Like I said earlier, not a business name. A business name will not afford you this opportunity. You need to be a public liability company to enjoy this IPO that I have talked about. Another set of persons that you can get investment from when you are coming under this equity financing is venture capitalists. You may be wondering, capitalists, are these not persons who just want to get profits at all costs? Not necessarily in this regard. Venture capitalists are private, individual, or corporate bodies who are looking for companies or businesses that are already doing well. They have competitive advantage, they have good markets, and what have you, anything that makes a business to be viable, they already have that. But they see that this company may need some level of expansion, exposure, and some other factors. So they bring in their finances into this business, and they have also seen that this company has the potential of growing very rapidly in a short term and even a long term. These companies can grow. So these persons, they come, they give you the investment that you need, the funding that you need for your project, for your expansion, and even for just growth, as the case may be. They invest this money with the view that within a short time they are going to start getting returns. If not immediately, they invest. But you must ensure that everything is discussed before this investment is made. How long is this investment going to last, and what are the returns? You need to discuss terms and conditions surrounding this investment that they are making. This is to help you not to lose stake in your own company at the end of the day, because these persons, they are investing in companies that you have control over. They're not just going to come into a company and dump their money there. They are not angel investors who just put in money because they believe you are going to grow. But these persons, they invest in companies that they believe they will have some level of control over. Now, if you are going to make any decisions, both financial and others, you must ensure that they are consulted. So you have to be ready to accommodate these persons. If you are someone who wants to make all the decisions by yourself, this may not be for you. But if you are open-minded and you want to grow not just by yourself, you want to grow with others, then this option is for you. It is said that when you go alone, you move very fast. But if you are going with some other persons, you get to your destination steadily. So you need to get it right before allowing persons to invest in your company. This venture capitalists, the company, they are as well interested in companies that are viable, not just any company they see on the internet or on the radio, wherever they see. No, that may not be the case. Your company must be viable, has competitive advantage, and has that growth that has been steady over a period of time for them to invest in your company. Another option you may have is crowdfunding. We know that crowdfunding is one option that many persons have been using in recent time. They open an account, then they put it out there in different social media platforms. They tell you, we have a company that is ongoing with some projects. They have some projects that are ongoing in different areas, and if you fund this particular project, this is the return you are going to get at the end of the day. So when this crowdfunding is happening, people who have little resources, they can invest under the angel investor. These persons, they are wealthy persons. They bring in huge amounts of money into your business. But crowdfunding, they are usually persons, thousands of persons, as the case may be. They bring in their little funds, put the resources together, and invest in your company. These persons could be 10 persons can come together under one umbrella and invest together, hoping to get profits at the end of the day. 2 persons can also come together to invest and get profit at the end of the day. So crowdfunding is all about getting multiple persons, not like 2-3 persons. They could be in their hundreds, tens, hundreds, and thousands. They put their resources together and invest in your company. These persons, they are not interested in the control. What they're interested in really is getting their profit and value for their investment. That is about the types that we can discuss today. Now, what are the advantages? Are there merits? Are there advantages? Are there pros and cons to equity financing in real estate sector? We'll be also looking at that very quickly. The first one we have there, the pros in equity financing, is it allows business owners to grow their business without having to bother themselves about funding their business, like accessing loans. We understand that getting loans to finance business is very difficult, especially for startup companies. If you're a startup company, there are certain requirements that may be put out there. Many companies are not ready to do business with financial institutions, in this case, are not ready to do business with persons who are just starting up, except they have persons who are recommending them that this person, I believe that this person will be able to pay back. But for equity financing, if you are relying on investors, you don't have to go through that hurdle to get funding for your business. So you just focus on running your business, because you may have someone who will pull in their resources to help your business grow. Another advantage of using this equity investment is you have more time to focus on building your business. You don't have to just focus on getting loans. It will take you time going from one bank to the other and getting rejected. But once you are able to pitch your business idea to certain persons, you get the investments you need. Another advantage is debt servicing. One of the things that has made many businesses to be closed down today is debt servicing. Many are unable to service their debts. There are some, because of the huge amounts and the terms and conditions that are put out there in the loan they took, they may not be able to meet up with the loan repayments, not even the interest. They can't pay either of them. At the end of the day, they have to close down their business or sell off whatever they have had to acquire in the course of running the business, just to offset their debts. And once that is the case, you lose out everything, your ideas, your time and investment, everything goes down the drain. But under equity financing, all these things, you don't have to bother about them. Everything you need to do, you focus on building your business and you get the money to you. So you don't have the fear of losing your business anytime, because someone is going to come and tell you today, okay, because you have failed to pay your debts, I'm taking over